Hey there. Hello, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers, and they're on the house coming to you from Palm Springs in the greater Coachella Valley area. I got a nice moderate day in terms of our heat, low 100s. In fact, actually, I think we're below 100 right now. Yeah, we're below 100 right now, high 90s. So almost sweater weather for us desert rats out here. But yeah, the weather's been pretty good, and the early stages of the summer, of course, we're going to certainly be soon hitting the one teens, and who knows, I'm sure we'll have a few days breaking that feared 120 threshold. But right now, it's pretty darn comfortable. In terms of what's going on in the world, of course, you heard we've got potentially a deal in Iran. We'll see about that. Sports world, of course, how about those Knicks? Man, oh man, I thought for sure we might get another game or two out of that series, but the Knicks basically bowled over the Spurs. The Spurs were ahead, 10, 11 points going into the fourth quarter, and they just couldn't hold the lead once again. So congrats to the Knicks. First championship in 53 years. I saw the news headlines this morning that they were having a massive crowd for their parade through New York City. So again, kudos to them. And of course, now I think focus is shifting to the World Cup, and who knows? I mean, I'm from what I'm hearing, I can't say I'm a big soccer fan, but it's always fun to get into sports when you get into a level of competition that's worldwide. So I can kind of get the bug, and I'm paying more attention to what's going on. And apparently, we have a pretty good shot. Our U.S. team has a pretty good shot at maybe going far, if not coming out on top. I think their next game is against Australia, as I recall. What I think is kind of hilarious, though, is the Scots. I guess they're here in the U.S. in droves, and apparently in Boston in particular. And they're running out of beer in Boston because the Scots just love their beer, and I just think that's hilarious. And of course, it's fun to see that they're having so much time, good times here. And that's the other thing that's kind of feels good, is that a lot of the folks from overseas who are coming to the U.S. to watch these games are pleasantly surprised for the most part that, hey, we're not such a bad place after all, considering some of the media likes to suggest otherwise. So it's kind of a feel-good situation that folks like it here, like what's going on here, like our friendliness and our culture and so forth. So I'm happy to hear that, and I hope we all as U.S. citizens can extend a warm welcome to all these folks. It's after all, it's sports. It's a competition, something everybody can get interested in and kind of come together on, and just have a good time and root for your teams, and of course do so in a good-natured way. And let's not get into any scuffles or anything worse, as sometimes happen when you get very passionate fans rooting for their team. So far so good in that department. So with that, we're going to go ahead and get into the usual part of our show at the beginning, both our rate grid and the 10-year bond yield. And of course, we've had some news this week with the Fed meeting, and you might think, maybe there's going to be some changes in mortgage rates, but more of the same. The bond market mortgage rate levels really haven't changed much at all this week, despite the news. And you can see that on the rate grid there. We're still in the low sixes for conforming loans. Those buy downs, the 3-2-1s and 2-1s, are starting in the 3s and the 4s. FHA and VA are still below 6. 15-year is about mid 5s. So these rates are good, and they're stable, and they've been like this for months. We were a little better back before February, before the war started. But nonetheless, the increase that we've seen has been pretty muted overall. And so I think that's a good thing, and something we should feel good about, and try to see what you can do with these kind of levels of rates in terms of buying a home. So in terms of the actual bond yield, again, we had the Fed meeting this week. Of course, when you look at this chart, it's kind of interesting, right? I mean, I guess when you see those kind of moves up and down, we would call that volatility. Now, yes, it's volatile, but in a relatively narrow range. We kind of briefly broke through the 4.5 level on the 10-year yield. Actually got down pretty low, closer to 440 early in the week. Then it kind of went up on Tuesday. A little bit of that Wednesday dip that Jeff likes to see. And then it kind of shot up early this morning, which of course was after the Fed meeting from yesterday, as the market kind of digested the the news that came out of the Fed meeting. Of course, we're going to touch on that here in just a minute. Then we had a nice little improvement going into later today. Of course, keep in mind this chart is based on Eastern time in the U.S. So, the market now, of course, is definitely closed. It's after 5 o'clock in New York. So overall, no big negative impact on the bond yields and therefore on mortgage rates after the dreaded Fed meeting that we just announced. And of course, that Fed meeting being run by our new Fed Chairman Warsh, who took over for Jerome Powell. So what's actually moving the markets? Well, we're going to give you a few bits of data. I think Jeff might even come on and kind of quiz me on some of these data points, so we can have a little bit of a discussion about them. Hey, Jeff.
Hey, Art. You were mentioning the new Fed chairman. It seemed to roll off the tongue of saying Jay Powell, and now it's like, okay, now what are we going to do? It's rewash.
You're funny you say that, because I've caught myself a couple of times when I bring up his name. It's like, you got to remember, it's not Powell. And I don't know why Warsh is just sort of a little bit harder. I mean, if it was Walsh, it'd be maybe a little easier, but it is what it is. It's his name. And actually we'll get into discussing that. I think I'm kind of reasonably cautiously optimistic that this change in the Fed chair position, I think, could ultimately be a good thing, at least for what we do in the real estate mortgage market. So,
well, we talk about volatility, and I like how you explained that in the 10-year that it's a very tight window. It looks like it's really wild. In fact, even when I looked at it, I said, "Holy cow!" And then I realized it is such a minor or minute area that it moves around, but it projects like it's very volatile. And I think that makes good for a lot of people, because I remember the days when we were talking, and it's like people were waiting because they're waiting to find out things to kind of calm down and be a little more steady. Well, that's really what it's been for a long time, hasn't it?
It has. And see, one of the things you have to keep in mind whenever you're looking at any of these kind of charts, you've got to be very mindful of how those charts are created in terms of scale. Because I've seen charts where the movement from day to day or during the day can look really kind of exaggerated, even this chart that we showed today. But when you pay a little bit closer attention, then you realize when you look at it, it's like all these up and downs that look pretty extreme. Well, guess what? These are all within a range of about 4.42 and 4.5. That's not a big range. That's what the finance guys call a narrow trading range. But the chart is made to look like, man, you've got these massive movements. And of course, it reminds me, I hate to bring it up, but some of the charts that we were seeing during the pandemic, where you would see some of these moves and the number of cases reported and the number of deaths reported and so forth. And I would look at those from day to day and go, my gosh, we've had a major increase. But then when you look closer at the scale and, the horizontal and the vertical in terms of what the data points are that are being used to make that chart, then you suddenly realize, hey, the scale of this chart's been altered to make it look worse than it is. And so that's part of what's at play with these kind of things.
I guess it just goes back to that whole thing. If it bleeds, it leads. So we have to make everything have a bleeding point, I guess.
Correct.
All right, well, let's get into this. So let's talk about home builder confidence. I think last week you shared some great data points on houses and housing, and this has a little bit different feel. Tell us about that.
Well, yeah, because see, that's one of the things that happens with some of these data points is that they really can change from week to week. So the narrative can therefore change as well. And so this week, they do this home builder confidence index, and this index has been what is considered to be a negative place now for quite some time. This time for May, it came out 2 points down from 37 to 35. So that was a downturn. But of course, keep in mind, anything below 50 is negative. So you look at the number and you go, okay, 3.7 was already negative, but now it's gotten worse at 3.5. And so when then you kind of dig into the story and what's the reason for that reduction in their confidence level, it's the same old story. Elevated mortgage rates, affordability, and of course, material costs. because that's the thing about, I think a lot of us, I think, are starting to realize, with the Iran war and the big jump in oil prices, oil is, even though oil is sort of a kind of, a lot of folks in the country think of oil as an evil, especially those who are more, concerned about the climate and so forth. And yet oil is so integral to the country and to our economy. It is people would be shocked to really pay attention to what extent oil makes up so many things in this country in terms of what we make, we manufacture, our products, and and so you got to realize is that that big jump in oil prices has had a negative consequence, both in inflation staying under control and in the cost of certainly goods and services, and in part because oil isn't, maybe in some part of the manufacturing process. So, builders are just pointing that out as to reasons why they continue to feel a little bit pessimistic about what's going on. And of course, what the overlying or the underlying issue with all of that in terms of home builder sector is we got a whole long way to go in terms of enough homes being built. As we have in the bullet point there, we're short of 1.2 million in housing units. That is a major, major number. And when you look at most localities, in terms of things like building permits and building starts, we are just kind of nipping away at that shortage, that $1.2 million number. I mean, we are not making great strides in catching up with that shortage. And so as a consequence, that's certainly just kind of making things, not so good. And in fact, you're going to bring up the next couple of bullet points where it kind of illustrates that, and housing starts also came out this week, 1.17 million, 8-month low. It was forecast to be 1.43 million.
That's a lot.
That's a big, drop off from what was expected. So, and who knows, there's probably lots of reasons for that in different localities and in states. Of course, we all talk about how in California, this state is not friendly to, home building. and then you even drill down into counties and cities in some of those areas, in part based on, the political environment and who's running those local governments. In some locations, they can be somewhat anti-housing, anti-growth. They're not interested in helping home builders build more homes because they perceive that there's negative consequences to that overcome the benefit of getting more housing. And it's an unfortunate approach, but it's still a factor, particularly here in California.
Well, Art, a couple of points there that when you bring this up is the shortage of homes. If I were a home builder, it feels like that should be a positive thing. Like, hey, there's this shortage and I have a great opportunity versus, hey, I'm trying to force more inventory in the market when we're already at, let's say, par level. And so that's a little strange. But something I do notice, or I have noticed lately, we've had a couple of people come out, service people come out to our home lately, and all of a sudden there's a line on there for fuel charges, and it's an upcharge paying for this fuel. And I gotta believe that the home builders who have been trying to absorb some of those prices finally said, "Uncle, I can't do it anymore."
Well, I think that's happening, and in part, we've already talked, on this program before many times, and it continues to be the case. I always say, look, I keep stressing for hoping that the resale markets will pay closer attention to what home builders do. They will move their inventory no matter what it takes, and usually what that means is they'll sacrifice some margin to get that inventory moving, because the absolute worst thing for a home builder is carrying inventory that's just sitting there and it's costing them money. Yeah, so what they do, of course, concessions are an integral part of their sales effort, but it, compresses their margins. Now you layer into that the higher oil prices, which are having an effect on material costs. That's a double whammy. It's like, we got to move the inventory, so we're going to offer that 3 7/8 30-year fix to our home buyers at this subdivision. But now, the cost of some of our materials are going up because of the inflation rate and oil prices and so forth, man, our margins are getting squeezed even further. And eventually, yeah, these home builders are going to get up in the morning and just get grumpier than they already are. And I think that's what this number, the index, and of course, supported by the housing starts number is just kind of revealing that in real time. And it's a struggle. And but like I said, they at least keep doing what they have to do to get those homes moving, which can be a benefit to home buyers. And frankly, I've pre-qualified some home buyers, referred to me by an agent, where they start off looking at existing homes, resale homes, and every so often what I end up hearing is, from the agent, oh well, they decided to go to Lennar or DR Horton or whoever, because and oftentimes what gets their attention is the incentives.
Gotcha.
And then they'll come back to me and say, hey, can you match this? Well, no, if Lennar Homes is giving somebody $20,000 in incentives to be used to pay their closing costs and buy down their rate, but it's only if you use Lennar Mortgage, well, as an independent mortgage originator, I can't compete with that. It's when I'm involved in, existing resale transactions where there's incentives involved, it's because it was negotiated to come out of the seller, just like the home builder. It can't come out of us. We just don't have the margins to be able to offer that.
Do we, you mentioned in this next part about housing starts and I'm just wondering how much do regulations play into that, and then causing delays to start a project. And of course, we all know the longer it takes to get, if you will, shovels in the ground, the more expensive that project becomes. And I keep hearing things like, well, now with artificial intelligence, they'll be able to move these things through this approval process much faster. Are you hearing anything about things like that could be a positive sign in the future for home builders?
Well, I hear the sound bites about how AI is going to help that. I don't think we're seeing evidence of that yet. Maybe it'll get there, but in the short run, I mean, and how is it that AI is going to help with the process? Well, maybe it'll help, a home builder be able to put together their pro formas and their proposals that they then have to go to the local government and, get approvals from the local agency to actually start building. Well, those folks sitting on those big desks where they're looking down at the home builder trying to say, please let me build this home, it's like they probably, I don't care how much AI you use to make your proposal, your pro forma look better, you still got to convince these people in the local governments to kind of grease the skids and help move things along faster. And we have a real world example based on a disaster. I mean, can you spell Palisades? I mean, what's it been now? I mean, a couple of years? And how many homes are being rebuilt since that disaster of all disasters in Southern California? A tiny, tiny little bit. So even that kind of really terrible, terrible event doesn't seem to have gotten our local and state government's attention about, we got to change this system and make it easier and more efficient to get homes built and available for this tremendous number of buyers who are starving for more opportunity, more inventory. So hopefully that'll have a beneficial impact on the pricing levels. But we're still, it doesn't feel like we're getting any closer to that, at least not fast enough.
What really kind of blows me away is, if you look, especially here in California, we have a habit of spending, as a politician, we have a habit of spending way more money than we have. And to me, I'm thinking, well, wait a second. If we had more homes being built, if we move these things on, just take the Palisades example, doesn't that add to the tax revenue?
Yes, it does.
It just blows me away. So if you delay it, you're delaying the revenue that could be coming into the city or the state or the county by just dragging your feet. I mean, there's a gentleman down the street from me, and he's had a sewer line, and it's been dug up for almost 45 days. He's waiting on somebody to come out and inspect it.
Oh my word. Well, yeah, going back to Palisades as an example, yeah, you're right about, if those things would start getting built, it's going to be more in tax revenue. Because if you think about it, think of all the trades. If they would put aside all the obstacles from the regulatory, blockages and get this stuff going. Imagine how many people would be put to work in that particular area to get all those lost homes rebuilt, and then the trickle down effect of those people have got to get paid, and the more they get paid, they're going to pay more taxes on it. It is so obvious to us common folk. It's like, why don't the politicians have the same common sense we feel like we have? I don't know. Maybe it's very frustrating. It's very bizarre.
Yeah. Well, I'm sorry. Let's go to the next one, because this is some good news.
Yeah. Well, yeah. Retail sales. I mean, man, oh man. I mean, again, you keep hearing these drum beats in the media and the headlines about the economy's lousy and things are just terrible, and still talking about grocery prices. By the way, last weekend I was at Ralph's and I bought 18 eggs for $2.99. So how come eggs are still not on the headlines like they were 2 or 3 years ago? It's like the good news about eggs is like, poof, it's gone. Nobody talks about it. But overall, yeah, there's still some issues with food prices. In particular, I would argue, not the grocery stores so much, the restaurants. But despite all of that, consumers are still spending. Now, that report, again, the media will kind of take it and try to get you to think it's not as good as it seems. Because, of course, what gets pointed out, 0.9 up from 0.5, that's a really big jump, almost double. Well, then the authors of these articles will say, well, wait a minute, you're not factoring in oil prices, because the retail sales number, of course, is based on what you're paying for products and services, which includes buying gasoline, because gasoline prices are way up. That's inflating the retail sales number beyond what it otherwise would be. But even if you peel away, the core items, food and energy, retail sales are still up. So despite the drumbeat of bad news and everybody struggling, people are still spending. And our economy is about 70% consumer spending. Yeah. So that's why you have to take a step back and look at this data and go, it ain't as bad as the media would like us to believe. And of course, not that the stock market is your best benchmark of the economy overall, but most stock prices inherently are focused on earnings, and corporations are making earnings. So if companies are making money, they're making profits, and their employees are spending, and the employment rate continues to be at almost what they call full rate of employment, about a little over 4%. You put all that together, and it's like we got pretty much full employment. Inflation's a little bit elevated, but you take out oil and food, it's pretty close. I don't know. I'd rather look at this as half full. Things are pretty darn good.
Yeah, I agree. So this next one, this is your favorite area.
Yeah, the Federal Open Market Committee. Of course, yesterday was the conclusion of their meetings, and the decision that was announced was already baked in. No change in the Fed funds rate, none at all. They just held steady. That was expected, and I think as a consequence, when you go back at that 10-year bond yield chart, we didn't really have that much of a move. A little bit elevated, yesterday afternoon, after the release was announced and kind of got digested, we had a little bit of an uptick in the bond yield, but already this morning it's kind of come back and we're fine. We're right back there in that mid 440 range. So what I think was somewhat optimistic about the decision and the press conference afterward is, again, with our new chairman, Warsh, a couple of things that I think are encouraging. One is he made it clear that there's going to be less focus on forward guidance. And, they're not going to rely.
What does that mean, Art? Forward guidance?
Well, it got to be, particularly with Chairman Powell in that, position, he would spend a lot of time interpreting the data and basically sort of verbalizing to the market observers, guidance as to where he thinks things are going. Our new Fed chairman is not of that mindset. He's less interested, really doesn't want to spend a lot of time, announcing these decisions, discussing some of the data points, and then giving folks, the market observers, some guidance as to what it all means. I mean, he's taken the approach of, well, here's the data. You can interpret it however you want. That's not my job. And I think that actually could be a good thing, because see, that's where I think Powell got into a little bit of shaky ground, where he got accused by some, observers, and one in particular, a guy over there in the big White House in D.C., who felt like he wasn't being totally objective and he was sort of being biased because he was giving too much of this forward guidance. And in fact, part of what came out of that yesterday was Warsh did not even comment on or publicly talk about, as I put in this particular section, the dot plot. And for what those of you who we've talked about this before, but for the newer viewers, the dot plot is part of the FOMC meeting where they take the 18 people who are part of the Fed panel, and they ask them to put basically on a graph where they think the Fed funds rate should be later in the year. And 9 of the 18 on this dot plot graph basically put one increase in the Fed funds rate this year, whereas the other 9, no change. But see, Warsh didn't even make an effort to discuss it. Now, of course, it's public information, so the media finds it and still talks about it, but it didn't involve the chairperson, Warsh, giving any guidance about what does this mean. Again, he was like, okay, dot plot is what it is. You decide what it means. I'm not going to comment on it. So, I think that's a pretty good thing. And then the other part of what came out yesterday is the belief that annualized basis by the end of the year, inflation is going to be at 3.6. Now, again, that's a little bit elevated even from where we're at now. And so between that and the 9 out of 18 predicting or betting on one Fed funds increase this year, that's why the bond yield did elevate just a little bit. And that's why in the third bullet point, as I put there, firm expectation for at least one rate increase. It looks like any Fed funds decrease is off the table for the balance of the year.
Well, Art, in a way, if somebody's listening to this, and we've got a nice audience here. So if you're listening to this, you're thinking, well, that's bad news. It's that whole thing of good news, bad news. It's like we interpret that as bad news because the rates don't go down, but it really is good news as it relates to what?
Well, it's good news as to the fact that inflation's not going back to 9%. We have full employment. We have an economy that's roaring along pretty good. People are still spending. The stock market's doing pretty well. Again, that's not an economic indicator per se, but indirectly what it's telling you is corporations are making money. And that's what their job is, to basically make profits for their shareholders. And so when you put all that together, you shouldn't panic if there's not going to be another Fed reduction. And we'll comment a little bit more about that when we get into our next discussion segment here about how that works. But gosh, it's not the end of the world. Even if we had one Fed funds increase by sometime between now and December, that's not going to be the end of the world. It's still about what do the labor numbers look like? What are the inflation numbers going to look like? And if it turns out this time we really do have a deal in Iran, then that only can be good news for oil prices, and therefore, the cost of products and services, the inflation rate, and then eventually mortgage rates.
Yeah, to me it feels like, and we'll get into it here in a second, but it feels like if I'm someone out there that I'm an employee, it feels like there's some solidity there. I'm back on solid ground because, as you say, across the board, a lot of companies are doing very, very well. Our economy is doing well, and then prices could go down, which I think that's all good news. And that's usually when the rates kind of go up because we don't need to artificially prop it up. Is that a fair statement?
That's a fair statement for sure. Yeah. Yep. Exactly.
All right. So let's get into this. I put some, and I think this is something that you've been talking about for a while, and we sometimes forget it, is on financial markets, they respond with reptilian-like minds to stimuli, and on rates could be higher for longer, meaning
the rate level we're at now, and then we've been at for several months, I would say, even in February before the run up from the Iran war, We were still in the high fives. So the point is, it's that narrow trading range again. I would argue that really for the past year, we've been around 5.75 to 6.5 in terms of overall, in terms of mortgage rate range. Again, that's a pretty narrow range. I mean, heck, I can remember in 1987 when I had an office full of, loan applications in process for buyers of new homes up in the North LA County, Palmdale, Lancaster area. And we had at the time a mortgage rate of 8% in April. And by November, it had gone up to 11.
Wow.
And
wow.
This was during a time when these folks were waiting for their homes to get done. And let me tell you, we had to scramble, us and our home builder clients, we had to scramble to figure out ways to keep those transactions together in the face of that kind of dramatic increase in rates. Well, we're not seeing anything like that right now. So this whole notion that rates are elevated and time for a panic, it's overstated, it's overblown. We all got to calm down. This is actually a pretty good trading range. And I think it's going to be this way for a good amount of time, probably for the next year or two.
Well, you said one other thing before we go to this next slide is you've said for a long time is like, beware of the headlines. If something, and hey, I come from a marketing side. So our whole goal is to have what we call grabber headlines, the stuff that will stop you from scrolling and check and click the link. But dig into it, because that's where the story is, right? That's where the facts are, not in the headline. And if somebody's just headlining it and then taking that out there and putting their own spin on it, and they hear somebody else talk about it, it's like, that's so far off from reality. Like these charts you're talking about, it's such a tight range. And if we have one rate increase between now and the end of the year, we're probably talking what, a quarter of a point?
At most. And probably not even that.
It's just not much of anything. So, all right. So I'll get off my stick here. So I want to talk about the Iran war is over. And again, I know I'm probably getting ahead of myself because, as I say, I don't want to get out on the end of my skis, but it looks pretty darn good. That tomorrow could be the day. And I'm just curious what the impact is on that, on things like oil prices.
Well, we've already seen some impact. It was within the last week and a half, oil prices were north of $100 a barrel.
Yeah.
Look at where they're at now, 74, 75. Now, where were they before the Iran war started? Around 60. So we still got a ways to go, right?
Yeah.
But that is a massive improvement from just a week or two ago. 100 plus to 75. That's a 25% reduction in the price of oil. Now, is that immediate? No. Is the impact on that in the country going to be uneven? Yes, particularly here in California, where we have the highest gas prices of any state in the union. And that was true even before the Iran war started. And we won't get into all the reasons for that. But, we're special in a negative way when it comes to oil prices and gasoline prices. But nonetheless, if that level we're at now can sustain itself and get even closer to where it was, down closer to 60, then that is going to end up being terrific eventually. We just got to be a little bit more patient and wait for that to happen. But as I think you're going to have on the next bullet point, have we already seen some improvement in gasoline prices? Sure, I've seen it. And I think 50 cents a gallon is about right. So when you think of that, okay, so does that help? I mean, is that going to help folks who are on the fence about buying a home? I think so, although I think it's going to be more like, it's more of a sort of a psychological benefit, just to be able to see that things are going in the right direction. Because I got to tell you, and I'm gonna get a little bit in trouble here, possibly, for all of those folks who've been really, really worried about and about gas prices and how it's affecting their household budgets and it's affecting having enough money to buy food and this and that and the other. Again, those negative headlines. So I'm a numbers guy. I thought, I'm going to take a closer look at this. What has really been the impact in dollars and cents? So I did a little bit of research. And in California, the average number of miles that a motorist drives in California is about 14,400. Okay.
Over the course of a year?
over the course of 12 months in 1 year.
Okay.
The average person drives 14,400 miles a year. So then the next thing I'd check on is what's the average mileage that a gasoline powered car in California achieves?
Okay.
Well, it's about 28 miles per gallon. Now that includes both your subcompacts that get 35 or 40. Again, we're excluding EVs, just gasoline powered cars. The mini compacts to the SUVs, the average overall, that range of different autos, it's about 28 miles to the gallon.
It's pretty good.
Yeah. So then what you do is you take, well, if you drive 14,400 miles a year and you're the average motorist and you're achieving 28 miles per gallon, how many gallons of fuel are you going to have to buy? It's about 518 over the span of a year. So then I took, okay, what's been the increase in gas prices since the war started? Looks like it's about $1.60.
Wow.
Okay. So then if you take that 518 times $1.60 and you do the math, how much more per month are you paying for gas at the current levels? Any guess what the number is?
A couple $100?
$68 a month.
Wow.
Now, I'm going to come across as being totally unsympathetic to all the folks out there struggling because of these high gas prices. But in reality, again, I'm a numbers guy. You got to look at the numbers at some point, and again, ignore the headlines.
Yeah.
And these numbers, I think, are pretty solid that I just quoted. I did the research. I looked them up. So the fundamental issue there is the average person is, having to spend $68 a month more for gas. I don't know about you. That's not the end of the world. Now, certainly for the very low income people, it's much more of a challenge. I get it. And I'm not trying to be unsympathetic to that. But for most of us, for the average person out there, I'm going to even go as far as say it ain't as bad as you think it is. But I took the time to at least figure out what's the impact. Now, in my case, I drive about 25,000 miles a year, so it's costing me about $115 a month extra. Do I like it? No. I'd rather not. No. But I had a meeting with someone at Starbucks this morning, and I bought myself a latte, and it was $6.95. Well, a lot of people do that every single day. And so, maybe you got to buy less lattes so you can put gas in your car. But I think that's an okay trade-off, all things considered. So
one is temporary, right?
Well, of course, the oil prices, the gas prices are temporary. I mean, I think unlike a few years ago when we were told, inflation was going to be transitory, well, it wasn't as transitory as we had hoped. I think in this case, the oil and gas prices, I think, and therefore inflation rates, I think is much more of an actual transitory situation.
Yeah, I mean, I was even pulling up this information here from Costco, which I was surprised to see. It's under $4, and that's just down at the local Costco here in La Quinta. Between $3.99 and $4.65 for their premium. So, right. I mean, come on. I mean, it would be one of those things. If I'm driving back to Arizona and I see that gas prices drop as soon as I get in Arizona, I'm like, why can't we do that here in it'd be under $4. Right. It's under $4 here at Costco. So, right. I think that's not such a bad deal.
Right. So
to take the pressure off of those buyers. Well, I almost feel like because you kind of, it's almost like you told the joke, or excuse me, the punchline to the joke. I got nothing now. I feel embarrassed to even put this up here because it's $68 a month.
Well, yeah, but see, the point is, like I said, what it does, it's a good psychological boost. So see what it does for a prospective home buyer. When you look at it the way I just described it and do the math, I mean, frankly, you got to take away gas prices as a reason you're not buying a home. You gotta take that off the table. That's not really a major reason why you're not buying a home. There's a lot of other factors that I think are more legitimate, frankly. So, let's be real about it and realize, this is a temporary inconvenience. It's not fun. None of us want to pay more. But in the scheme overall of what's going on in the housing markets and what it's going to take to get more people in homes, I'm sorry, I'm just not willing to accept that gas prices are a major issue in terms of that whole process. So that's why I wanted to throw those numbers out there just to give people a better handle on really what the impact has been on all of us. So
I think again, it goes back to let's look at the data. Thank you very much.
Right.
All right. So the next one is, we talked about this a little bit, the new Fed chair. If the economy picks back up without the Iran war, where do we see interest rates go? And I think you've already answered that.
Well, I have. The other thing I would point out, because I did a little research on this as well, because the concern is, and the bond market can fall into this trap. They go, all right, well, we've got a pretty strong economy. We've got these higher gas prices, oil prices. That's inflationary, so we're worried about inflation could even get worse from here. And again, there's a tendency with some in the economics world, who just automatically in a static way say, okay, a strong or even overheating economy, and we've got high input prices like oil and gasoline, that doesn't bode well, and we're going to end up even losing grasp of where the inflation numbers are now, and there could get worse. So it got me thinking, well, if you recall back before the previous president, Biden, took office in 21, election in 20, and he took office in 21, I was like, well, I decided I'm going to go back and look at what was the economy like, say, between 2017, 2020. And then what was the CPI during that time? Well, as it turns out, the average GDP from the beginning of 2017 to 2020 was about 2.5%. That's a pretty good number. If we could have consistently 2.5% growth in the economy, the national economy, that's considered a good economy. That's a pretty strong economy. Any idea what the average CPI inflation rate was during that time?
Gosh, now you got me thinking maybe I should go higher. I thought the inflation was pretty low. I thought it was like under 2%.
It was 2.1.
Okay.
So in recent memory, we have an example of when the economy was doing very well, averaging 2.5% growth in GDP. And in 18, we had a couple of quarters where it was really high. And yet during that entire period of time, CPI, inflation rate, was very much in control. I mean, almost right on the target of the 2% the Fed's going for. So ergo, it doesn't.
What's the reason? What's the reason for that? What's the trick?
Well, I think the point is that a good, strong economy at full employment doesn't necessarily mean inflation is going to skyrocket. It doesn't have to. And so we have that recent evidence to underscore that point. And so I think just, again, folks need to realize that can definitely happen again. I think these inflation numbers are transitory. If we really do have a deal on this war thing and oil prices get back down into 60 plus, I think this inflation rate, we're going to get very much back toward that 2% target. And this thing could really be off in the races on all fronts in a very good way. And of course, now what that can mean is you could then at that point have more sellers decide to put homes in the market, and you could have more buyers come out, and then that's going to be an interesting combination because there are so many buyers. I think that actually could push prices up even with more inventory. So that I think is the watch out for in terms of anybody looking at the housing market and wanting to jump into it. The current conditions, I think, are actually pretty good, which I think is the next point you want to bring up. So
yeah, we're talking about the inflation. Absolutely.
Yeah. So then again, what I was just hinting at is what is the opportunity for a home buyer now? Well, I used our current desert housing report here in the Coachella Valley as an example. Okay, in terms of the data, because it was released here just in the last week for the month of May.
Okay.
Let me give you some numbers. Now, the median price of a home that sold here in the Coachella Valley in May was actually 3.6% lower than a year ago.
Oh, really? Oh, yeah. Okay. Okay.
Now, that doesn't mean home prices are falling in a huge way. What it simply means is sellers had to make some adjustments, right? So that's one number. The median price of a home that got sold in May was 3.6 lower than May of 25. What is the month of sales in May of 26? 5.4, meaning there is currently in May supply equal to 5.4 months based on the current sales rate. That's almost back to the normal 6. Okay, considered normal. Days on market, it's now at 49 days. getting close to 2 months.
What's considered normal when it days on the market? Because I mean, I know we've all been through that thing. Like, I got 7 offers in 3 days and closed in 22. But what's normal?
Well, yeah,
You've
you're
been
talking
doing it
about
for a long
those
time.
numbers are back in the pandemic when the days on market was like 18,
Yeah.
right?
Yeah.
The normal was historically considered about 60.
Oh, okay.
When
All
you
right.
look at the inventory at 5.4, normal was 6. Days on market is normal is 60. We're at 49. And then let me give you one more data point, and then we'll pull it all together. The price premium discount ratio. In May, single family detached homes, 3%, meaning the home sold for 3% below list price. Condo, 3.5% below list price. So nowhere in the Coachella Valley, all 9 cities, was the closing price at a premium over list. So when you put together the drop in median price sold from a year ago, the months of sales at 5.4, days on market at 49, and the premium discount ratio at -3 to 3.5, put all that together, what we have is a scenario right now where sellers are having a little difficulty accepting this data. They're still holding on, thinking their home's their castle and it's worth more than everybody else. And the buyers, of course, still adversely affected emotionally and psychologically with, oh, the market's terrible, and rates are too high, and home prices are too high, and gas prices are too high. I can't afford to buy a home. And they're not looking at this data and going, aha, I have leverage. Buyers have leverage. And I'm going to keep screaming that from the mountaintops. Buyers have leverage, and they need to jump on that while they still can. Because if this war gets over, oil goes down, gas goes down, economy keeps roaring along, probably even gets better. There's going to be a time when I don't care that the rates are still at 6+, maybe they'll get in the high 5s. Eventually, more buyers are going to come out. And those of you who are considering buying a home now, you're going to have a ton more competition. And when that happens, sellers are going to go, aha, the market's back for us. And they're going to start holding on their prices and raising them. So to me, the opportunity right now is just screaming at anybody thinking of buying, do it now while you can. And again, I've had more examples in the last week or two. We're working on closing a deal right now. I've told this story over and over again. I'm going to repeat it. They approached me for a pre-qual, buying a condo in Palm Springs, and the buyer was going to offer below list. I asked him how much, and he told me, and his agent told me. I'm like, okay, here's the numbers. Here's your pre-approval letter. Can I give you another example of how to get that same concession in a better way? Well, we just are about to order the closing docs in that deal, and he's buying a condo with 20% down. He's getting a note rate of 6 3/8 with a 3-2-1 buy down.
Wow.
So he's going to have 3 3/8, 4 3/8, 5 3/8. So he won't even have to hit his note rate until this time in 2029.
God, that's great.
Well, by then, a lot can happen, and mortgage rates certainly by then should be better than what they are now, and he'll have that refi opportunity. But in the meantime, he's capped his worst case at 6 3/8. I've got another pre-qual I'm working on just this week. Same thing. Lady selling her home in Ohio, moving back to Rancho Mirage. She's looking at a condo and 575. I asked her, is she going to offer 575? No, we're going to offer 30,000 below. We want to offer 545. Okay, well, here's your numbers for that. However, can I give you another example? I gave her 2 examples. Get 30,000, pay all your closing costs, get a permanent buy down in your rate to 5 1/4, or pay all your closing costs and get a 3-2-1 buy down, so that you're going to be at, in her case, 3 1/4, 4 1/4, 5 1/4. That payment schedule until this time, June of 2029, 3 years later.
Wow.
That is how you should be buying a home right now. The data supports it. 3 to 3.5% discount in price from list price. That's what's happening right now. If I'm a buyer, I would be telling my agent, we're going to make an offer, but we are going to want 3 to 3.5% concession. Why? Because the data shows that that's what's happening. This is what you need to tell that listing agent, so that that listing agent can tell their seller, and everybody can get on the same page. The seller gets their home sold. the buyer gets to finally buy, and they get a rate schedule that harkens back to the pandemic days where you start the first year at three in the low threes.
That's fantastic.
What are you waiting for? I mean, I hate to get animated about it, but it's just like I said, I keep screaming this at the mountaintops that that's the opportunity that exists right now. And my job, what I'm here to do, is help people see that and make it happen.
Well, I think I'm not in the market for buying a home. We own a home. You know that. You've helped us with the mortgage. But I'm like, these are exciting times. These are opportunities. It's like, yes. I can hear Warren Buffett say, when there's blood in the streets, that's when you buy, right. Not when it's cleared up. And if people wait, it could be pretty quick. I mean, if it moves as quickly as we've seen with gas prices and oil prices, things could turn around very rapidly, especially I'm guessing there's a pent up demand of people who say, we need to buy, but we want to wait for whatever that is, that it's going to force this pretty quickly, isn't it?
I think it's going to. Yeah, that's why I'm urging people who have been on the fence to do it now. Now, as we touched on, I think I touched on last week, some segment of those prospective potential home buyers, who, especially on the younger side, I think they've got the dilemma of making some hard choices, because there's a segment of that group who are very much focused on lifestyle and lifestyle experiences, going out to dinner all the time, going on a lot of trips, even long weekend getaways, having these sort of memorable experiences. And again, I love to have fun as much as everybody. I love nice dinners as much as anybody. But when you're young, you just think like that'll never end, and you don't think about the future. You really got to rethink that, understand that housing is your pathway to wealth creation, and buy a few less lattes. Don't go out 5 days a week, go out once a week or maybe a couple of times a month. Reallocate your money for $300 or $400 car payments, not $800 to $1,000 car payments. You got to make those hard choices. And if you do, this is your opportunity. It's right there in front of you, and you got to jump on it while you can, because eventually the competition is going to be back. The sellers are going to take that leverage away from you and, basically tell you my price or go away. And by then it's too late. So the opportunity is here now. You got to prepare and go after it. And if you do, you're going to be pretty happy.
I like it. Well, Art, thank you so much for changing format a little bit today, but it seemed like we're able to drill down and use some of your expertise and, quite frankly, your knowledge of over 4.5 decades of doing what you're doing. And I think it's important to talk some of these things through and get a little bit more information. If you like this type of format, let us know in the comments. And if you don't say anything, no, just let us know. And Art, with that, I'll turn it back over to you. Thank you so much.
Okay. Thanks, Jeff. Thank you, everyone, for watching and listening. I'm going to give you a little hint for next week, and I haven't even told Jeff about this. But next week, I'm going to tell you a little bit about the lock-in effect or the lock-up effect as it relates to current homeowners. A lot of those folks are not looking to buy because they've got 2 to 3% interest rates. Well, there's another factor that's creating this lock-up effect that many of you who don't own a home maybe are not even aware of, and those of you who do own a home maybe haven't even thought of. And that has to do with whatever that point in time is where you're looking to sell your home. You potentially could have a tax event, meaning depending on what you sell your home for, you may be subjected to a tax on your gain on sale of the home. Now, the current limits for a single person, $250,000. Your first $250,000 of gain when you sell your home is exempt from being taxed. If you're a married couple, it's $500,000. On next week's show, we're going to touch on that. I'm going to dive deeper into that whole issue and show you why those numbers are no longer appropriate for our current market and why they need to be changed, and if they are changed, what that's going to do, I think, to help this lockup effect and really open up the housing market, which again is why if you're a buyer, you ought to consider getting out there and buying now, because if this change that I'm seeing could happen does occur, then that's going to have a big impact on home prices. And so as a consequence, you may want to jump on the opportunity now. So with that, enjoy your weekend, enjoy the World Cup, and have some of that beer. Hopefully you can find some after the Scots drink it all, at least back east. And then we'll see you again next week on the next edition of the Mortgage Minute. My name is Art Alvarez with MortgageWorks. So long. Take care.